Hi everyone, Billy here from TradeProsper, and welcome to our introductory course on what are call options. Now, whether you are a bull or a bear, options allow you to very efficiently take a market view without taking on excessive risk, especially if you are a purchaser of options. Now, in most cases, if you are bullish in terms of your sentiment, you tend to buy call options. But what exactly is a call option? A call option is an instrument in its own right. So in other words, the option itself can be bought and sold. A call option can be traded on practically all types of securities, such as stocks, FX, futures, and commodities. But it's important to understand the functionality of a call option. The buyer of a call option owns all the rights to the call. So in other words, the buyer decides whether or not they want to use the option. In this case, the buyer of a call therefore owns the right, but not the obligation, to buy the underlying security up until a predetermined future date and time and at a predetermined price. There's a couple of terms that we need to be aware of when dealing in options. So let's go through them one by one. All options will have the following. It'll state whether it's a call or a put. In our example, a call option is the right to buy the underlying, whatever the call option is written on. The strike rate is the price at which the purchase will happen when you exercise the option. The premium is something we pay up front to own the rights, in other words, to own the option. The expiration date is the date by which we have to decide whether or not we're going to use the option or let it expire. So let's look at a payoff profile for a call option at maturity. If the underlying share price has gone up past the strike rate, so in other words higher, you can exercise your call option and buy the underlying shares at the original strike rate. So you can see this is quite a benefit to have because you're buying something far cheaper than where the market price is currently. So in this instance, we'll say the option was exercised. But what if the spot rate goes the other direction? So what if the share price falls to below your strike rate? Well, the nice thing about options is you can just walk away from them. So in this example, nothing will happen and we will expire the option. Should in this case you still wish to purchase the shares, you can do so in the open market, and at this point it'll be cheaper than where you would have bought it had you exercised the option. The value of a call option therefore increases as the underlying spot rate of the security, in our example the share, moves up. I hope you enjoyed our brief introduction to call options. This is Billy from TradeProsper, and I hope to speak to you soon. Bye bye.